Hello, knowledge seekers. In this episode of 20-Minute Books, we delve into The Little Book of Common Sense Investing by John C. Bogle, the esteemed founder and former CEO of the Vanguard Mutual Fund Group. This insightful book contrasts actively managed funds with index funds and makes a compelling case for the benefits of investing in low-cost index funds over higher-risk actively managed mutual funds. Primarily aimed at individuals looking to enhance their investment strategies and deepen their understanding of investment mechanisms, Bogle's well-articulated arguments are backed by his extensive experience in the investment field. Having established one of the largest investment management firms, Bogle shares his expertise through a straightforward and accessible approach, making complex investment concepts understandable for both novices and seasoned investors. Whether you're a beginner, eager to start investing, or someone looking to improve your investment portfolio, the Little Book of Common Sense Investing is a vital resource that equips you with the knowledge to make smarter, more effective investment choices. Let's explore why Bogle advocates so strongly for index funds and how this approach could potentially pay dividends for your financial future. The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. Introduction. Discover the beauty of simplicity in investing with index funds. Imagine wandering through a vast store packed with an overwhelming array of chocolate bars, some plain, some with nuts and caramel, others boasting exotic flavors. Picking the right one can be tricky, right? The same goes for investing in mutual funds. With countless types available, deciding on the best investment might seem complicated and risky. After all, you want to ensure that your hard-earned money is being put to good use. This narrative dives into a straightforward investment choice that cuts through the complexity: index funds. Unlike their more intricate counterparts, index funds offer a transparent, cost-effective way to invest. This chapter will demystify why all mutual funds aren't created equal and how index funds shield you from the pitfalls of high fees and unnecessary expenses. You'll discover the distinctions between a passively managed fund and those that are actively managed. We'll explore why the lure of low fees should be a leading factor in your choice. Moreover, we aim to equip you with strategies to steer clear of the perilous market bubbles that could threaten your investment. Through this journey, you'll see that sometimes the best approach is the simplest one. Choosing index funds might just be the wisest investment decision you can make, ensuring your portfolio grows steadily without falling prey to the common traps that ensnare many unwary investors. Part 1. Why actively managed funds may cost you more than you think. Entering the stock market can feel like navigating a labyrinth, especially when trying to pick winning stocks. It's a complex field that drives many to invest in actively managed funds, where a pool of money from multiple investors is managed by professional fund managers. These experts continually adjust the portfolio in response to market changes, aiming to maximize returns. However, this route comes with significant drawbacks, primarily due to its high-cost structure. When you invest in actively managed funds, you're not just betting on stocks, you're also paying for the fund manager's expertise and the associated brokerage fees. These expenses accumulate, eating into any profit you might earn from the investments. Despite the allure of potentially high returns from smart stock picks, the reality often falls short. Actively managed funds typically do not outperform the market in the long run. The strategy of buying undervalued stocks and selling them at a profit may sound appealing, but consistently outstripping the overall market performance through speculation is a formidable challenge. This underperformance is largely due to the fundamental limits of earnings within the stock market and the inflated costs associated with active management. For instance, if you had invested $10,000 in an actively managed fund in 1980, by 2005, annual fees alone could reduce your return by as much as 70% compared to a low-cost index fund. Index funds simply replicate the market's performance. but they do so with minimal fees, allowing investors to keep more of their hard-earned money. This chapter highlights the critical point that while actively managed funds might seem like a proactive choice, the associated costs and operational limitations often degrade their potential returns in comparison to passive, low-cost index funds. Part 2. Why betting on past fund performers might not secure your financial future. You might be tempted to channel your investments into an actively managed fund, especially after considering the enticing performance of a select few. However, before you make that leap, it's crucial to scrutinize how these funds stack up against the overall stock market. Regrettably, the track record for most actively managed funds isn't encouraging. Many of them either wind up bankrupt or fail to deliver significant returns. Despite the steep fees charged for the supposed expertise of financial gurus, a stark reality emerges from historical data. Out of the 355 mutual funds that existed back in 1970, only 24 consistently outperformed the market and are still operational today. Investing in these funds seems akin to gambling, where you're hoping financial experts can miraculously grow your funds. Yet, the sobering statistics hint at a different outcome. You might just be squandering your money. Moreover, even the funds that have historically outdone themselves offer no future performance guarantee. It's a common investment pitfall. Past success does not necessarily predict future results. The market conditions, strategies, and sheer luck that may have propelled a fund to excel over the last few decades are not guaranteed to persist. Consider, for instance, the role of fund managers. A stellar fund manager could very well be nearing retirement. There's no assurance that their successor will mirror their success. Also, the financial landscape is ever evolving, and the opportunities that once existed might not be present in the future. This unpredictability adds an additional layer of risk. In summary, placing your investment bets on funds that have previously performed well is fraught with uncertainty. The conditions that favored their past success are not permanent, and betting solely on historical performance is a risky strategy that could impact your financial security. Part 3. Why the allure of actively managed funds might be misleading investors. The ongoing popularity of actively managed funds, despite their often underwhelming performance, may leave you puzzled. Why do people continue to invest in them, and what might they be overlooking? Firstly, there's a significant gap in awareness regarding the real costs associated with these funds. Actively managed funds are notoriously expensive due to high operational fees, yet this critical detail often remains obscured. Fund managers tend to highlight potential high returns without clarifying the net gain investors might expect after all fees are deducted. It's a startling fact. Out of the 200 foremost successful funds in the late 1990s, an overwhelming majority reported returns that were ultimately not realized by the investors due to various hidden charges. Secondly, investment decisions are frequently driven by emotions and trending market sentiments rather than solid financial advice or individual analysis. The late 1990s serve as a textbook example. During this period, the investment in the stock market surged from $18 billion in the early half of the decade to a staggering $420 billion, influenced by an overvalued market and the investment trends of the time. This frenzy ended in significant losses for many when the market bubble burst. The pattern of following the herd, investing because everyone else is doing it, is particularly prevalent in choices regarding actively managed funds. Despite their high costs and uncertain outcomes, these funds remain appealing due to effective marketing and a common misconception of their potential for high returns. Given these insights, it prompts us to think beyond the conventional and often misleading allure of actively managed funds and explore more reliable and cost-effective investment opportunities. As we navigate away from these high-stake gambles, the question then becomes, What are the smarter alternatives available for securing your financial future? Part 4. Embrace the stability and efficiency of index funds for long-term investment. If the pitfalls of actively managed funds have cooled your enthusiasm for standard investment options, don't despair or start stuffing your savings under the mattress. There's a reliable, efficient alternative that merits your attention: the index fund. Distinct from the often pricey and unpredictable actively managed funds, index funds stand out for their simplicity and cost effectiveness. These funds maintain a diverse portfolio, mirroring the broader financial market or specific sectors. But rather than attempting high stakes investments on fluctuating market trends, index funds adopt a passive strategy. They hold on to their diversified portfolios indefinitely. This not only sidesteps the risks associated with short term volatility, but also significantly slashes operational costs. Index funds are so streamlined because they track the collective performance of all stocks within a selected index without attempting to speculate on individual stocks' performance. This absence of speculative activities means no hefty fees for frequent buying and selling, no costly financial consultants, and no fund management overheads. Your gains? Purely the net returns from the market sector the fund covers. One might ponder if this approach could miss out on profit opportunities by not buying low and selling high. Yet, history and data suggest otherwise. In the long run, the inherent ups and downs of market prices realign to reflect the genuine value of the stocks. Hence, by persistently maintaining a stable and expansive portfolio, index funds generally surpass the returns of actively managed funds, delivering genuine stock value without the burden of excessive management fees. Now, with a grasp of why index funds are a superior choice for safeguarding and growing your investment, let's explore how to pick the right one to ensure your financial goals are met effectively. Part 5. Opt for the most cost-effective index fund. In your journey to selecting the right index fund, one key criterion stands above all: cost efficiency. Each index fund carries what's termed an expense ratio. This represents the sum of management fees and operational expenses customarily associated with running the fund. While these costs are often modest, generally under 1%, they can considerably accumulate over extended periods. Take, for example, the Fidelity Spartan Index Fund, which boasts an impressively low annual expense ratio of 0.007%. Contrast this with the JP Morgan Index Fund's expense ratio of 0.53%. Both figures are under 1%. Yet even this small difference can significantly impact your investment's net growth over something like a decade. Given that the performance of index funds is designed to mirror the broader market movements, the smart choice is to select a fund with the lowest possible cost structure. It's crucial to understand that a lower expense ratio does not mean sacrificing performance. Rather, it means enhancing your long-term returns by minimizing unnecessary costs. By choosing wisely, focusing on the expense ratio as a pivotal decision factor, you position yourself to maximize your investment gains without falling prey to high, often unjustifiable fund management fees. Part 6. Approach new investment trends with caution. In the dynamic world of investing, it's vital to approach new trends with a healthy dose of skepticism, especially when it comes to safeguarding your hard-earned money. The realm of index funds is particularly susceptible to the winds of change, given the fierce competition among providers to capture investor interest. Since their inception in 1975, index funds have proliferated, growing from a single offering to a staggering 578 competing options today. This explosion has not only diversified choices, but also intensified the battle among funds to attract investors. Established funds primarily compete by slashing their fees, appealing to cost-conscious investors. Conversely, the newer entrants often try to differentiate themselves by promising potentially higher returns, through innovative stock picking methodologies, albeit usually at higher costs. Take, for instance, the New Copernicans. This group deviates from traditional strategies like weighted market capitalization, where stocks are purchased proportionally based on each company's total market value. Instead, they might base their portfolio composition on different metrics, such as corporate earnings or dividend payouts. However enticing these novel approaches may seem, they bring their own set of risks. Predicting market values and stock performances with consistent accuracy is an uncertain endeavor. Therefore, sticking with funds that maintain a conventional and transparent portfolio could be a wiser choice. Moreover, given the unpredictability of new investment trends and their unproven track records, keeping your focus on low costs remains prudent. This cautious approach helps ensure that you're not unwittingly sacrificing your financial security for the lure of potentially higher yet uncertain returns. Final summary. The core insight from this exploration of investment strategies is clear. Steer clear of actively managed funds. The excessive fees associated with these funds can devour a significant portion of your potential earnings, often leaving you with less while enriching financial intermediaries. Instead, the smarter choice is to channel your investments into index funds. These funds are not only more cost-effective due to their lower fee structures, but also tend to outperform actively managed funds in the long run. By investing in an index fund, you position your finances to grow steadily without the unnecessary drain of high management fees. So, to truly make the most of your money, opting for an index fund is a financially savvy decision. Thank you for joining me today on this journey of learning and discovery as we explored the insights of another thought-provoking book in our growing library of knowledge. If you've enjoyed our time together, please take a moment to follow our podcast, give us a 5-star rating, and share 20-minute books with other knowledge seekers. Your support truly means a lot. Don't forget to join me again in the next episode, where we will delve into another enriching book. Until then, happy reading and happy listening.